are live. So guys, throughout the week I got a couple of emails that I've been waiting to get for a while now. The first of which was a whoa, excuse me, sorry. Anyway, the first of which was a price alert email from Seeking Alpha for one of the stocks on my buy list saying that it officially hit $130 per share. This was on December 20th. This was a stock that I've been waiting to get down to this level for a while. And the second email was the same thing, another price alert for another stock on my buy list that hit $140 per share. But one of these guys, I'm kind of having second thoughts about, which we're going to talk about in this stream, but they're getting extremely close to buying range. But anyway, before we get into all of that, welcome to another Dividend Happy Hour. This is officially the 30th live stream that we've done. So a quick round of applause for that. Actually, better yet, why don't we do a quick cheers? Guys, thank you so much for joining me. God, I'm tripping over my words already. Thank you so much for joining me for another week. Hope you guys had a fantastic week, and here's to a good one. Merry Christmas to you guys too. I'm just sipping on some water tonight, guys. Keeping it clean. Through the next couple days, I already know I'm going to be partaking in the festivities, so gotta kind of relax a little bit before getting into all of that. But anyway, guys, let me know in the live chat, and also if you're watching the replay, let me know in the comments below, which stocks did you buy this week? I'd be curious to hear what you guys picked up. Personally, it was a pretty dry week for me. I didn't buy any stocks, which was the first week in a long time that that's happened. But as you guys may or may not know, I stopped contributing to my portfolio for the month just to save some money for Christmas gifts and whatnot, but I'll be picking it back up in January. But yeah, let me know in the live chat a couple of things actually. What you guys bought this week, number one, and also number two, let me know what you're spending on for tonight's Dividend Happy Hour. And while you guys are submitting that, I have a few announcements that I want to get through. So number one, first announcement, you guys know I normally put out my videos Sundays and Wednesdays, but because of Christmas, because Christmas is this Sunday, I'm actually going to release the normal Sunday video tomorrow on Saturday. So you guys, you will be getting a video from me tomorrow morning at 8 a.m. Pacific time. Be on the lookout for that. It's going to be a great video. But number two, second announcement, guys, let me put this on the screen. I've been working quite a bit on a spreadsheet version 6.0, and this is just a little bit of a teaser for what you can expect to see in this new version, which I expect to release realistically sometime in February. But in this new version, which I'm still working on, there will be support for multiple portfolios. Number one, this is something that you guys have asked me about. A lot of you guys have asked me about this because I know a lot of you guys out there, including myself, have more than one portfolio. Maybe you have a taxable account in a Roth IRA or a 401k or some other sort of retirement account. And it'd be nice to track all of it in one place. So we're going to be adding that to version 6.0. Number two, I fixed the sector data. It usually auto-populates, but there's been a lot of problems on the spreadsheet with that not loading properly. So I fixed that issue so that will no longer ever again be a problem for us in version 6.0, which is very exciting. This is probably like the biggest thing you guys reach out to me about, whether it's comments or emails. This is one of the big things I hear from you guys. So that'll be taken care of. And then number three, which is equally as exciting as the first two, there will be an expanded watch list in version 6.0. So, if you guys use the watch list, which I don't know how many of you guys do on this spreadsheet, there's going to be more data that it gives you. So those are the three big things to look out for in version 6.0. There might be some other things that I forgot to put on that screen. There's some other really cool features I'm sure that I've implemented that I just forgot about, but that's pretty much the gist of it. And now, I actually do have one more announcement, guys, which we'll be going through Seeking Alpha in this video. You guys know I'm a big Seeking Alpha fan, and right now they are running the deal of a lifetime, which you'll know if you saw my Wednesday video. But right now, guys, so you can get 1 year of Seeking Alpha Premium for only $39. Now, usually this is $239. So right now, through this end of the year flash sale, you're able to save $200 for your first year of Seeking Alpha. And if you guys want to grab that, take advantage of that deal, there is a link to it in the description of this video. So definitely check that out. If you've ever thought about trying Seeking Alpha Premium, now is the time to do it because, guys, $200 off. Think of the dividend stocks you could buy with that extra $200. It's a pretty unreal deal, so definitely take advantage of that. There's a link in the description. Now, I want to put some of your purchases on the screen and talk about that for just a moment before we get into tonight's main event. But for those of you who are just now joining, we're about 5 minutes in. Thank you so much for tuning in. Hope you had a fantastic week, and I'm happy to see all 78 of you in tonight's Dividend Happy Hour. I always look forward to these. So let me put some of your purchases here on the screen. We'll just go through them real quick. And I also want to say, Just some shout outs to all you guys out there that I missed at the beginning. So Coach Tim, what's going on? Put me in, Coach. We got Kevin here. We got Shaping, Charles, Pat. Pat, I see your question there, and I'll go through the questions. We'll get to the Q&A later in the video. And as we're going through this, if you guys have any questions on dividend stock investing, be sure to put that in the live chat. We'll go through it after the main event. Shamir, what's going on, my friend? Omar, Rashawn, the legendary Rashawn. We've got Christian, Phil, Chris, Steve, Ultra Runner, Harris, TCAF, Driving America, finally made it to a stream. Thank goodness. We got Will. We got Big Bad Kevin Burgess in the building. UKRN. Phildo the Great. Good to see you. Lucas, my man. Who else we got here? Swampy Kips in the building. We got Mose B. Jark02. It's probably not how you pronounce that, but I might have said what's up to Charles. If not, Charles, how you doing? Bill, good to see you. And I think that about covers it for now, but let's put some of your guys' purchases on the screen. So starting here with, who's the first one on the list? Ooh, Steve. Why don't we put you on here first, Steve? Steve picked up some Intel this week. Great time to buy Intel. I'll be briefly talking about it in tomorrow's video. So yeah, definitely one of the more discounted stocks. They've had a terrible month. I think they're down like 13, somewhere in the double digits for the month. Omar also picked up some Intel as well as some T-Row and MPW, all of which will be featured in tomorrow's video. So you're going to want to check that out, Omar. TCAF picked up, or sold actually, some Bank of America and JP Morgan, bought some Realty Income and AbbVie. Good stocks. Great choice. Coach picked up some Starbucks, some Iron Mountain. I think that's Iron Mountain, right? And then some Ford. Yeah, Ford, man. Yeah, that one's definitely cheap for sure. Swampy Kips here picked up some Kroger, which we are going to be, I don't want to spoil it, but we're going to be talking about Kroger a little bit later in the video. Great pickup. Christian picked up some Apple, quite the shopping spree here. Apple, Costco, Procter & Gamble, Realty Income, Microsoft, Johnson & Johnson, and last but not least, the holy grail of dividend ETFs, SCHD. Good pickups, Christian. Let's see here. Who else we got? Charles, some Apple, Ally, and AT&T. Bill picked up some HBQ, HMC, and SWBI. Phil bought some TD, Toronto Dominion, right? And then some KRC. Gotta love that, Kilroy Realty Corporation. And I also see some of your guys' what you got going on beverage-wise here. Looks like some good stuff. Kevin sipping on a little bourbon and Coke. Good for you, my friend. Let's see. Pat drinking some chocolate milk. Classic. Yeah, I actually had some chocolate milk earlier today myself. Harris picked up some Intel, some Target, some Lowe's, QQQ, and Ally. Harris, probably a handful of times this week, he's hit me up saying something about Ally, just how it keeps going down and how he's picked some up. Harris, I don't remember exactly how much your Ally position is down, but I think it's one of your worst performers, if I remember correctly. But otherwise, well, actually, all of those really good pickups. Excuse me. Shaping bought some LAMR. I actually have never heard of this, but it sounds interesting. A billboard REIT with the most market share, and he's also sipping on some chocolate milk. Nice. Lucas sipping on some whiskey. Good for you, man. Picked up some Starbucks and VSP. KC in the building. Some more FRG in H-Row. Same stuff for me most weeks. Yeah, I get you. I'm in the same boat. It's usually more or less like the same small handful of stocks, you know. Nieces and nephews picked up some Walgreens Boots Alliance, some Intel, and some Leggett and Platt. WBA had, was that yesterday or Wednesday? They had a pretty nice decline in share price one of those days. Let's see. Chris here picked up some Walmart, Apple, and bought 2 shares of Intel, MPW, and some QYLD to officially hit 100 shares. Nice, man. That's a cool little milestone. Miguel here, we're just going to go through 1 or 2 more guys. Miguel picked up some Target, MPW, Tyson Foods. Man, these are all great pickups. Apple, Intel, and Leggett and Platt. Now, oh, actually one more. I can't leave out Swampy. So Swampy picked up some STWD, which I have never heard of before. And, oh, I got a super chat coming in. Got to scroll down. Okay, Raymond, Ryan, this is for helping me with Spreadsheet 5.0. Still need more help. First of all, Raymond, thank you so much for the super chat. That's super nice of you, man. And I don't know if you saw my email back to you. This maybe was like the 14th or the 15th. I think I sent an email back to you. So happy to help. Feel free to respond to me or whatever. You got my email, so reach out at your convenience. I'm happy to help you out. We'll get you sorted out one way or another. So anyway, guys, with that, I think we should get into tonight's main event. So like I mentioned, there are, and for those of you who are kind of now just coming into the stream, earlier this week, I got a couple emails, both of which were price alerts from Seeking Alpha, notifying me that two stocks on my buy list, which are the stocks that I am pretty certain that I'm going to pull the trigger on. I'm just waiting for the right price. But I got these email alerts from Seeking Alpha notifying me that both of them had hit my my target price. And the first one, guys, and you guys might already know what these are just based on the thumbnail, but the first one is Apple. Okay, on December 20th, Seeking Alpha let me know that Apple officially hit $130 per share. Now, if we go over to Seeking Alpha, which I'm going to switch the screen here in just a moment, if we go over to Seeking Alpha, we can see that it's really not too far off from that now, guys. $131.86 per share currently. And, you know, Apple has not had a good month. If we take a look at its share price performance in the last 30 days, it's down 12.73%. So Apple has seen quite the big drop in the last month. And year to date, they're not faring too well either, where they're down 27.5%. But we dividend investors, guys, this is an opportunity that we wait for forever. And I can't tell you how long ago it was that I set that price alert for Apple. I probably did that when Apple was at like $160 per share, just knowing if I wait patient, that, you know, I probably will get what I'm after, because things come to those who wait. And that seems to be happening here with Apple as it has come down so much. And I'm happy to see it, guys. Really happy to see it coming down in share price, hitting $130 per share. But I got to say, it's still not quite where I wanted. This is much better than where it was, but I'd still like to see it a little bit lower. And I'll talk more about that in just a moment. But I do want to talk about one of the downsides to investing in Apple. As great of a company as it is, which we'll take a brief look at or quick look at its financials in just a moment, but one of the downsides to investing in Apple is its just perpetually lofty valuation. And if we take a deeper dive into that, I mean, Seeking Alpha gives them an overall valuation grade of an F, which if you guys, you know, remember your school days, that's not good. You want to stay far away from those Fs. And I'm proud to say I never got one of those in my day. I was a pretty good student. But anyway, as far as the PE ratio, it's sitting at 21.35, which, you know, in most cases we'd consider that slightly high, okay? Kind of the rule of thumb that many of us dividend investors use. I've seen this from a lot of investors out there. I know you guys follow this rule of thumb. 20 is kind of the threshold, right? Anything 20 and below for like a normal company like Apple or Procter & Gamble or a Tyson Foods or, you know, what have you, anything 20 or below is considered decently, you know, attractively valued. But this is slightly over that, which is not terrible, which, you know, I'm saying this is a downside, but it's actually not too bad, and I'll touch on that more momentarily. But this PE ratio is still about 17.5 higher than the sector median, but for Apple, this is a bit lower than usual. It's 7% lower than their 5-year average, which is about 23 for the PE ratio. Now, how is this good? Like, why is this a good thing? Now, for a lot of companies, especially Apple, and this probably goes without saying for some of you guys, even though the PE ratio is a bit high, it may be justified. And we'll see that if we take a quick look at the financials, which we'll go through right now, guys. Just take a quick breeze through the income statement and the balance sheet, okay? So first and foremost, their revenue is growing very consistently. Hopefully you guys can see that chart. It's not in the middle of the screen where I want it, but you guys can see that revenue is doing nothing but going up year after year after year for the 10 years or for the last 10 years, and likely before that as well. Same thing profit as far as the gross profit goes. And if we scroll down to the bottom line, looking at the earnings per share, this is also going up, you know, seeing a very similar trend going up and up and up. And furthermore, they're buying back a buttload of shares. Like in the last 10 years, they've bought back about 9 billion shares, which is 9/18/27. That's about 33%, maybe over 33% of their shares outstanding, right? So that's pretty dang good. They're increasing shareholder value by buying back shares and also with the dividend. So two great ways that they're giving value to shareholders. And if we go over to the balance sheet, one other plus to Apple is that where is it? They don't have any debt. I mean, they do have some debt. They have total debt. But if you compare the debt to the amount of cash they have on a net basis, it's negative $36.6 billion. So having said that, I mean, they say Apple has one of the best balance sheets in the business. Yeah, one of the best balance sheets around, let's say that. And it's certainly true. Like, it's hard not to get excited about a company that has no debt, that is buying back shares, seeing tremendous growth, and pays, you know, albeit a lower dividend. The yield's less than 1%, but that dividend growth rate is pretty high, pretty close to double digits. So, there's a lot to love about Apple, and that's why we see it with its perpetual high valuation. And so, having said that, it's a premium company, so, it's not surprising that we might have to pay a premium price. But the question is, after its year-to-date performance where it's down 27.5%, is now the time to strike? Okay, it still has that higher PE ratio, but, is it low enough that it might be considered a good value? And if we take a look at, let me switch screens real quick. If we take a look at alpha spread, which is going to show us the intrinsic value for Apple, they give it a base case intrinsic value of $127.62, which if we go back to Seeking Alpha real quick, after I got that $130 price target alert, I set a new one before I looked at alpha spread for $127. So that's where I'm likely trying to buy it. And this is about the same number that they give it for a base case intrinsic value. Now, worst case, they have an intrinsic value for Apple of $103.50 per share, which means at this point, it's still 22% overvalued, okay? That's quite a bit overvalued. Even with its base case, it's like almost there, still 3% overvalued. But if things work out to be really good, better than they expect, better than, even the average expectation, the best case scenario, they give Apple an intrinsic value of $187.34, meaning that it is still 30% undervalued. And if we go back to the summary page, taking a look at the share price performance, it really wasn't too long ago that they were up at about this price point, right? So back in, where was it? Back in just August, it's a little bit below, but back in August of 2022, just, 4 months ago, they were sitting at about $175 per share, which is really not too far off from where they have the best case intrinsic value. And I would not be surprised that if it's only a matter of time before Apple gets back up there. So long story short, I'm looking to buy Apple probably at around, I don't think it's a bad price right now, but I'm looking to buy it probably around that 127. Mid to low 120s is kind of the range I'm looking for. And just considering how it's moved recently, year to date, in the last month, in the last few months, I would not be surprised if it keeps going down a little bit more. And it doesn't need to go down too much more for me to pull the trigger on it. And the cool thing is, you guys have heard me tell this story before. Every Christmas, every birthday, Ryan gets money to put in his Charles Schwab portfolio. So upon, once that hits my brokerage account after Christmas, there's a good chance I might use that money to pick up some shares of Apple and start a position. But if I do, whichever way I decide to spend it, you guys will be the first to know. Now, moving on to the second stock, guys. The second stock that hit, that I got alerted on the price target there, the price alert, was Target, okay? Target earlier this week, yesterday actually, officially hit $140 per share, which is pretty good. If we take a look at its share price performance, I'll switch screens right now. If we take a look at Target's share price performance, it was just earlier this year that it was like nearly $250 per share. This was back in April 2022. So 6 months ago, half a year ago, no, that's 8 months ago, excuse me. Can't do math tonight. But 8 months ago, Target was $250 per share. It's now $100 per share less, which looks really dang good, guys. And in the last month, Target's also not had a great month, where they're down about 12.5%, with a year-to-date loss of about 38.3%. So they've seen even bigger losses this year than Apple has. And just very much like Apple, Target tends to have a pretty perpetually high valuation. Their forward PE ratio is 25.5. And I actually probably stand corrected here. I probably spoke too soon, because their 5-year average PE ratio is only 17.85, which by our standards, like kind of what we were talking about earlier, is much more favorable than this 25.5, which begs the question, is Target, just based on its valuation, the PE ratio and the share price performance, is now the time to strike with Target? And I used to think yes. I was a big fan of Target. Like I said, it was on my buy list, okay? And there still is a lot to like about this company. We're going to take a quick look at the financials. Much like Apple, we're seeing pretty nice growing revenue, at least in the last 4 years, okay? Prior to that, it was decently flat if we look here, but it's really taken off since about 2018. If we scroll down to the bottom here, looking at the earnings per share, that's seen some pretty decent movement too. Definitely has gone up in the last 10 years. And they're also buying back shares here, which is really good as well, right? Now, the thing about Target that's different with Apple is Target has quite a bit of debt on the balance sheet. Not that that's unmanageable, and I haven't taken a deep dive. Well, we could probably see how much of it's long-term debt. We'll get to that in a sec. But right now, they have about $18.4 billion of net debt on their balance sheet. And let's see how much of that is long-term debt. So most of that, thankfully, is long-term debt, which is not too shabby. Now, taking a look at their cash flow, this means they have what, about probably $3 to $4 billion in current debt due in the coming year. And I'm just, this is a very simplified explanation. Like, I have not taken a deep dive into their debt lately, but just in the trailing 12 months, guys, they're negative on the free cash flow. So that's not the best, which means they'll probably have to dip into the cash they have on the balance sheet to pay down their current debt. But in the trailing 12 months, they are seeing negative free cash flow, which I don't expect to last forever, but in the meantime is not super great. And just taking a quick look at the dividend stats, I know we didn't see this with Apple, but Target does have some pretty nice dividend stats. Nice 3% yield, officially over 3% just because of the losses in share price. Payout ratio is pretty decent, right about 50%. I'm comfortable with that. Nice double-digit 5-year growth rate, and they are a dividend king with 54 years of growth. So like I said, there is a lot to love about Target, and I was really hyped on this stock and really wanted to buy some Target and add it to my portfolio until recently. There's one other stock that I started looking at, which I mentioned earlier in this video. There's one other stock that I started looking at recently, and I'm at the very beginning of my research with this new company. But from looking at this company, it's kind of dulled the shine on Target in my eyes. Target doesn't shine as bright as it used to after I found this new stock and started looking at this new stock. And what this new stock is, guys, I'll pull it up in just a moment. Let me just type it in here. But real quick, and I'm going to give you a hint. I actually want you guys to guess this in the live chat and also in the comments below if you're watching the replay. Can you guess what this new stock is? I'll give you a hint. It's similar in nature to Target in the sense that they are both grocery retailers. And I'll give you another hint. Someone mentioned it. Well, I mentioned it earlier in this video. So do you guys have any guesses as to what this new stock is before I put it on the screen? I'm curious. See, I know one of you guys is going to get it. Let's see. Walmart. Caleb said Walmart. That's close, not quite. Walmart's a good one too. Okay. Uh-oh. It's coming in. The right answers are coming in. We've got Journeyman. He guessed it. He guessed it first. Kroger. Oh my gosh, these all just came flooding in. Okay. You guys are good. Okay. Man, you guys are really good. Yeah, Steve's like, you already said Kroger. I know. Just seeing if you guys are paying attention. Yeah, so this new stock, guys, is Kroger. I'm really hyped on Kroger right now. And we're just gonna, I don't want to go too deep into Kroger because, another spoiler alert, I am talking about it in tomorrow's video a lot more in depth. So I'm going to save all of that for tomorrow's video, but just kind of a very rough overview in general. Like I said, I'm at the very beginning stages of my research into Kroger, but the more I look at it, the more I like it, at least lately, especially in comparison to Target. I'm liking Kroger a lot more right now than I am Target. And you guys will just have to stay tuned for tomorrow's video to see exactly why. But either way, I don't see Target making its way into my portfolio anymore. And Shaping here says, I'm skeptical regarding Kroger. I'm skeptical since the Albertsons acquisition. I'm going to have to read more into that. Like I said, I'm at the very beginning stages of my research into Kroger. But from what I've seen at a glance, from the valuation to the financials to the dividend stats, yeah, I'm liking what I'm seeing with Kroger. And just as a company, I'm really liking it. I'll talk more about it in tomorrow's video. I won't keep going on about it. But anyway, guys, that's pretty much all I've got for you on this main topic. Let's move into the Q&A, take a quick sip of water. And real quick, if you guys are still here, there's 127 of us in the stream right now. If you've not done so already, be sure to hit the thumbs up if you're enjoying the Dividend Happy Hour. Give this video a big like. It would mean the world to me. Also, if you're watching the replay, please do so. And if you're not subscribed to the channel already, what the heck are you waiting for? Also, one more thing. I don't know how many of you guys are already signed up or even know that I'm doing this, but every single week I put out an email newsletter through Retire with Ryan, which is my website. But every single week I put out a free weekly I put out a free investing newsletter, and it's a lot of fun. I talk about just some general thoughts on, dividend investing as well as what's going on in my portfolio. I answer your guys' questions that are submitted through comments or through email or what have you. And I'm also sharing any videos, podcasts, articles from Seeking Alpha or otherwise all these things that I watch, listen, and read throughout the week that I've found helpful or informative or interesting, I pass all of that along to you guys in these newsletters. So there's a lot of great curated content in these as well. And if you guys want to check this out, once again, it's totally free. There's a link to it in the description. You just got to click that and put your email, and you'll start getting those newsletters, which have been going out every Thursday morning. So a lot of good stuff. Now, with that, let's get into the Q&A. I'm going to scroll back up to the top because I know Pat. I saw this before the stream even started. Pat had a question. So Ryan, what is your favorite MLP? And my favorite MLP, which stands for Master Limited Partnership, is EPD. Enterprise Products Partners, which is a midstream energy company. They have pipelines that run all across the country. Excuse me. And so far, it's been a really good investment for me. Nice high yield. Goodness gracious, excuse me. I believe they're a dividend aristocrat with exactly 25 years of growth. I might be off a couple years, but yeah, great MLP. I've been very happy with that as an investment. Good question. Let's see here. Next question. And with that, guys, start submitting your questions in the live chat. I'll go through, and we've got about 35 minutes left in tonight's live stream. And so I'll try and get to as many questions here as I can for you guys. Let's see. And also, too, like, let me know just kind of not related to investing. What are you guys doing for Christmas? You guys have any big plans? Any holiday traditions that you follow every year that are kind of fun and would like to share? I'd be curious to hear what you guys have going on for the holidays. Hopefully good stuff. And I hope you guys made the nice list. I know a few of you out there, it's questionable. I'm looking at you, Shamir. Just messing around. Let's see. So this is an interesting comment. So Bot Aim Gamer says, guys, I need stocks that pay out dividends in January, April, if it's quarterly basis, January, April, July, October. What should I get that is cheap at the moment? Now, typically when someone asks these questions, attached to it is a follow-up question. Okay, why do you need a stock that pays dividends in those specific months? What is the need for that specific pay period? And the reason that is often the follow-up question to questions like that is because, it honestly doesn't matter. Well, actually, let me take a step back. It shouldn't be something that you put much weight into when considering potential investments. The payment period is like the very bottom of the totem pole. And furthermore, like, people get so hung up on, does it pay monthly? Does it pay quarterly? It's like, guys, it's just, that's like I said, way bottom on the list of important things to look at when it comes to researching stocks. Okay. Steve, so question about Seeking Alpha. Does Seeking Alpha ever green you? I mean, do they bill you again next year if you don't remember to cancel? So I'm sure they do. And I would imagine, though, that they send an email prior to, and I don't know this for sure, to be honest with you, Steve, but it's possible that they send you an email reminder prior to charging you, just letting you know that your annual subscription's about to re-up. I don't know that for sure, though. Jay says, what do you think the inflation rate will be for December? I have no idea. I really have not done a good job of paying close attention to that. I don't even know what it's at right now. You guys will have to let me know in the live chat what the inflation rate's at, because I don't know. Okay, Lucas, any bold predictions for 2023? I have some very bold predictions, my friend. So, a couple things. Let's see. Okay. Two things, actually. I would not be surprised if at least the first maybe couple quarters of 2023, we saw more red in the market than we do green. And I also would not be surprised if many of us hit some really cool dividend investing milestones. I think, I know that's kind of a non-answer, but yeah, I don't know. No real solid predictions. We're just gonna have to see what happens. Let's see. It is fun to think about, but I do think we'll see more red at least. Wait a second, Caleb. Yeah, I'd like you to expand on this if you don't mind. If you're purchasing stocks every week, then you are doing something wrong. What exactly do you mean by that? Because I think a lot of us buy stocks every week, actually. I personally do. I don't know why. What's wrong with that? There are only a certain amount, following up to that, there are only a certain amount of great companies, and I can tell you they don't go on sale every week. But some have been on sale for weeks and weeks and weeks and weeks. Like, man, I've been buying KRC for months now, just averaging down every single week. That's just one example of many. Intel is another one. Apple potentially right now. Target potentially right now. It's all relative, really. Yeah, Casey, I didn't even know Seeking Alpha had price alerts. I mostly like to use that site to play with the trolls in the comments. Yeah, I've started. I've seen Seeking Alpha slowly but surely start to roll out more portfolio tracking. This isn't. I mean, price alerts isn't necessarily portfolio tracking, but I've seen Seeking Alpha come out with some more portfolio tracking features as time goes on, and I hope they continue down that direction because that seems to be like the one missing component to the platform. They're great for stock research, I think. I mean, you can look up financials. You've got the crowdsourced information, all the articles, the news, all the news stuff that comes in is helpful too. I really like being able to listen to the earnings calls and follow along with the transcripts through Seeking Alpha. And it just, I talked about watch lists on my free spreadsheet earlier, but truth be told, as far as watch lists go, I don't use my own on my spreadsheet. I use Seeking Alpha just because I think it's way better. But yeah, there are a lot of trolls on the comment section of the articles. Okay, this is a good question. Do you think an Apple dip is a sign of the bottom? No, no. No, I think like I said, I would not be surprised if companies keep continuing to see some more compression. I think as long as inflation's still somewhat of an issue, and there's still supply chain issues out there as well. I think as long as these things are still present, we're not out of the clear yet. And I don't think that. How do I say this? So I think we've started to see inflation come down a little bit, right? We're seeing it, maybe we've seen it peak and have seen it come down, but just because it's starting to come down doesn't mean that it's still not high, and it doesn't mean that there's still not other issues as a result of the high inflation that we've seen. And I think that those will take some time to get worked out. And in the meantime, while those are still issues, which like I said, might take another quarter, another couple quarters, as far as inflation getting back to normal, that might, I don't know how long that'll take. This is really my first time going through all this stuff, but I don't think it's fixed overnight. And so I think while the issues are still present in general, I think we'll see some more red in general. Maybe not in every sector. Maybe not, I don't know. We'll see. Let's see. Let's see. This is an interesting comment. Yes, sometimes you have to take your value investing hat off in order to buy a stock. Yeah. And I'll talk about this more in tomorrow's video, but when it comes to looking at intrinsic values, like for example, what we saw on Alpha Spread, they give the worst case, the best case, the base case, or if you're reading something like an Arcus report or a Morningstar report, which also give, intrinsic values or fair values of stocks. When looking at these things, like, it's not the end all be all. You shouldn't look at these numbers and take them as gospel. Like, for example, Alpha Spread, saying, like, worst case scenario, Apple's, like, if you really want to be conservative, you'll take the worst case scenario. Apple's intrinsic value is $107 per share. Seeing that number, it's nice to have some sort of concrete number for sure, but seeing that number and choosing to hold off on buying a company, buying a business strictly because of that one calculation, whether it's your own, whether it's Alpha Spreads, whether it's anyone else's that you're looking at or referring to, I think you need to take them with a grain of salt because there's so much room for different interpretations, and everyone's going to come up with a slightly different number, I'm sure, or even a drastically different number. So when looking at intrinsic values or when doing discounted cash flows, like, they're good things to do, but it's only one of the tools that you have at your disposal. And you have to look, when deciding whether or not to buy a stock and what price to buy it at, you have to look at the entire picture, not just what the discounted cash flow says. And sometimes too, like we get in our own way by putting too much weight into those intrinsic values. And the good thing about dividend investing, while true, the higher the price you buy a stock at, you increase your valuation risk as a shareholder. But the good thing is you're still generating cash flow, right? It's just not as high as it would be if you bought lower. And so that's where you have to at your own discretion decide what's the price that I feel good about buying. Like if I'm buying Target right now at $140 per share when it's at a 3% yield, is that good enough, or do I want to wait for it to get down to $120 per share where it might be just rough numbers, where it might be a 3.2% yield? Is it really worth holding off for that lower price when it maybe will not come? I don't know. It's a tough thing to nail down. Anyway, let's keep going. That's something that I think we dividend investors and value investors, because I think the two really go hand in hand, right? I think that's something we do think about a lot. But I also think, like I said, a lot of people really get hung up on the discounted cash flow numbers or the intrinsic value numbers, when there's a lot of different there's a lot of different inputs that go into those calculations that can have an effect on the final calculation. Like for example, Kevin here said Apple's fair value in Morningstar is $130 per share, which is a bit higher than what we saw from Alpha Spread, right? And I know if you go watch someone like Dividendology, who's got great content, if you go watch some of like a video that he did on Apple or what have you, he might have a slightly different number than what Morningstar says or what Alpha Spread says. So it's a bit subjective. Okay, so let's do this. So Aaron wants to know, hey Ryan, could you look at SUI a bit more during the live stream? I'd like to hear what you think about it. So yeah, let's take a quick look at that. Let's dive into that real quick. So did I say SWI? I meant SUI. So SUI is Sun Communities, and I don't exactly know what type of assets they have, but it's a real estate investment trust. This says it right here. A portfolio of 603 developed motorhome, RV, and marina properties, maybe for like houseboats or something, comprising maybe not houseboats, nearly 159,300 developed sites and over 45,700 wet slips in dry storage spaces in 39 states, Canada, Puerto Rico, and the United Kingdom. Now, I took a quick look at this one earlier today, I believe, and it looked pretty good from what I saw in the financials. So if we just take a quick look, taking a look at the revenue, really nice growth, especially in 2021, right? So look at that. And this may be due to people spending, just with lockdowns and such, people were spending more time doing things outdoors. So this jump in revenue could potentially be a result of that. Maybe they acquired some more properties or raised their rents on those things. I don't know. I don't exactly know. And I could be off base there too. But then furthermore, if we look at, where's the FFO? Right here, the AFFO, which is what they use to pay the dividend. This is going up very steadily as well, which is fantastic. And if we look at the FFO payout ratio, which is the percentage of how much of this number they're paying to the dividend, it's not too shabby. It's actually decreasing over time, 64%, 54%, 47%. So pretty comfortable numbers there. And if we look at the dividend stats real quick, decent dividend yield, okay, 2.5%, which I think is low for a real estate investment trust. And the 5-year growth rate's kind of low as well, 5.5%, considering how I guess average the dividend yield is. And they only have 5 years of dividend growth, which isn't too shabby. But looking at this, they do have 18 years of consecutive payments. And if we zoom out on the dividend history chart right here, looks like there was a pretty substantial period of time where they were not growing that dividend, which is okay. Because they've since made up for it in the recent years. And they, just based on the financials, I'd be surprised if they weren't able to keep that trend going. And if we look at the valuation real quick, this does, it actually looks okay. It's not too bad. Price to book, 2.24, okay? And the forward P to FFO, which is like the real estate investment trust equivalent of the PE ratio, 19.48. But we can look at them the same. So it's under 20. It's not too terrible. Overall, and I would have to take a deeper dive and look at just kind of what sort of properties they have really. But at a glance, like the financials look good, but the dividend stats and the valuation, I think there are better out there. And I'm not going to keep shoving this stock down your throat, but like an example of a stock that I think looks better, like on all fronts, is KRC, just as far as REITs go. And I think even just using those same comparisons, just the financials and the dividend stats and valuation, perhaps. There's some other REITs as well, like IIPR, I think is looking better. Who else? That's the only other. Oh, MPW. It's another one, which might honestly be one of the cheapest stocks on the stock market right now. So I do think that there's better options out there. But, you know, the type of real estate they own sounds interesting at least. Thank you for asking about that one and bringing it to my attention, Aaron. Yeah, so Casey says, going back to Apple, 103 is too low for worst case, in my opinion. Brand Mo and their expansion into financial services plus native user ecosystem puts it higher than that. Slow extrication from China is also a plus. I agree. And that was one thing I was happy to see recently where they said that they're making an effort to get their chips manufactured here on, you know, home turf. That was one thing I really like to see. And I'm really hoping that it's possible, like stranger things have happened. It'd be interesting to see them maybe get those manufactured from Intel. Let's see what happens. I don't know. Who knows? Okay. Let's see. Okay, now let's keep going down. Funny. Driving America here says, regarding Kroger earlier, I'm at a Kroger distribution center making a delivery. That's too funny, man. Too funny. Oh, Christian here. This is an interesting take. So I work for Kroger and I'm allowed to contribute up to 20% of my 401k contributions to KR. Plan on retiring early and would like to add KR to my taxable account. Is it bad idea to have that overlap? I don't think so. I mean, I don't think so. Like if you contribute up to your maximum of Kroger and decide just based on your total portfolio when you look at your 401k and your taxable account combined, which soon you'll be able to do, which with my free dividend portfolio tracking spreadsheet version 6.0, stay tuned. But, you know, if you max out your KR contributions in your 401k, put that all towards Kroger, and you decide that's not enough for you and you'd like to be more heavily weighted in that stock, then maybe add some more to your taxable. Excuse me. Let me keep going here. Okay, the man. Can you do a quick comparison of ARCC and ORCC? Yeah, we'll do a quick comparison. Very like surface level though. Just using Seeking Alpha real quick. So let's go over here. So one of the premium tools is a stock comparison tool, which is perfect for what we're doing here. So ORCC and ARCC. And we'll be able to compare all of their stats side by side. Very easy. Excuse me. So just starting here with the price return, we can look at total return as well. Year to date, it looks like ORCC is seeing more of a drawdown in share price than ARCC, okay? Now, if we zoom out across a 5-year period, the same is true, but not by much. ORCC is seeing less returns by about 1.3% now, yeah. Oh no, actually, excuse me, I totally missed that negative. ORCC is seeing a much greater drawdown than ARCC. It's like basically ARCC is doubling the returns of ORCC. It's like the complete opposite here. Now, if we look at that on a total return basis, guys, yeah, so ARCC is still dominating, 6.7% compared to 89.18%. So ARCC is, has a definite advantage in terms of total return across the last 5 years. Now, scrolling down, ORCC does have a higher dividend yield, which once again is not the end-all be-all for sure, just one advantage that they have. What else can we look at? I mean, year-to-date, just share price performance, we already saw this. It's pretty similar. Beta is a little bit, no, it's pretty similar. They're both trading, at least in the last 2 years, with less volatility than the market as a whole, which is no surprise. And that's really all it gives us for the comparison. But if you want to do a deeper dive into, oh, is that? Yeah, it's good. But if you want to do a deeper dive into, guys, what is going on here? Sorry, if you want to do a deeper dive into ORCC and ARCC, I would start with their portfolios. What type of businesses are they investing in or loaning to? What do those loans look like? That's where I would take a look. And honestly, like Kevin Burgess might, just in the live chat, might be able to give a much better comparison than I did just now, because I know he knows quite a bit about BDCs. Jim here. What's the temperature in Las Vegas? 4 degrees Fahrenheit here in Omaha. So today, I don't know the exact temperature, but it's been pretty warm, like decently warm during the day. So you can walk around with, for the most part, you can walk around just like in a t-shirt and pants if you want to. But I will tell you, during the mornings, it's been chilly. Mornings and nights have been really cold here in Vegas, but during the day, it's been nice, been very sunny, like not a cloud in sight. Let's see here. So haven't looked at Kroger. They are a very low margin business. That's why I've kind of stayed away. I mean, fair enough. You know, one of the things about something like a Kroger versus a Target is one might argue that Target is a bit more, how do I say this? Target, well, it's in the consumer discretionary sector, so Target might not be as stable during these tougher times than something like a KR, which is strictly groceries. I know Target has groceries too, but I don't know if most people go to Target strictly for groceries. Maybe like some small stuff here and there. Nothing wrong with Target either too. Like obviously I was like this close to buying it, but I'm kind of more of a fan of Kroger right now. Okay, Joshua Cook, this is a good question. What's your top 3 dividend growth stocks? Starbucks, not in any particular order really, but Starbucks, I might give you more than 3. Starbucks, Snap-on, Lowe's. Yeah, probably those. I like those 3. Okay, Kevin, I heard you talk about this one in the, or I saw you talk about this one in the Discord recently. So CSL, any thoughts on CSL? Let's go take a look. I got to say, I've never looked at it before. You mentioning it in the Discord was the first I've heard about it, but CSL is Carlisle Companies Incorporated, and let's see just what this company is first and foremost. So they operate as a diversified manufacturer of engineered products, basically across the world, construction materials, interconnect technologies, fluid technologies, and they produce building envelopes for commercial, industrial, residential, single ply products, foam, insulation. Okay. So basically a lot of the things that go into building homes. That's one of the segments at least. Sounds like they do a lot of stuff. Industrial sector. I've been liking stocks in the industrial sector lately. I think there's a lot of great companies there. Now let's go take a look at their financials real quick. I'd have to just spend more time with it to get a better understanding of what they actually do. But you know, Kevin, I know you've got a good picker, so I at least want to look at it. So revenue is looking great, right? Like pretty steady growth across the last 10 years. And looks like maybe they keep a near like 20 to 25% gross profit margin just based on this, just at a glance. Scrolling down, take a look at the earnings per share. I bet we're going to see steady growth there. Yep. Nice steady earnings growth. I mean, for the most part, you know, but if we're just looking at a trend line, that would be positive. Nice reduction in shares outstanding. They're buying back a lot of shares there. Looks great. Dividend per share is increasing. Fantastic. Very low payout ratio. Let's take a look at the debt situation real quick. Okay, $625 million in cash. The cheddar with about $3 billion in debt. That's not too shabby, okay. $2.3 billion in net debt. What's the cash flow looking like? So $2.3 billion in net debt. If we scroll down, take a look at their levered free cash flow. So about $500 million in free cash flow in the trailing 12 months. And it looks like that's somewhat standard for them, at least between 350 to 500 free cash flow every year. So that's not terrible. Looks pretty good. And then the dividend stats. Okay, so low yield, not that, which is fine. Low payout ratio though, right? Well, like we saw that on the income statement a moment ago. Nice, nice double-digit growth rate with 45 years of straight growth. Okay, that's looking pretty good. Man, huge jump in dividend. Man, look at that. What? Dang, that's crazy. That's wild. I wonder why they raised it so much. But let's take a look at the valuation. PE ratio is looking pretty good, 12, which is quite a bit lower than the 5-year average. Okay, price to book's a little bit high, 4 for the forward. Price to cash flow is not too bad, 10.65. Just take a quick look at their profitability too. This looks to be pretty good. So, okay, nice return on equity. Wow, that's pretty high, 31%. 13.5% return on capital. That's great. Return on assets looking good. Yeah, this is looking nice, Kevin. Like I said, I'll have to spend a little more time with it to understand what they actually do, but just looking at the numbers, yeah, that looks cool. Thank you for sharing that one. Okay. This is a good question. So what is your annual dividend goal for 2023? My annual dividend goal would be to, and I know I can do it, is going to be to hit $2,400 in annual dividend income, which would put me at an average of $200 every single month, which is going to be so sweet. So yeah, that's my goal for the end of 2023, and I think I can hit it. And yeah, actually, I want to put it back on you guys. Let me know same question to you guys. What is your annual dividend income goal for 2023? I'd love to know. Okay. You're going to have Decade Investor as a live stream guest. Oh, okay, I think I was just watching a video from him earlier. Decade Investor. Yeah, I mean, at some point, I think that'd be cool to do. Yeah. I think Decade Investor is in the Discord group now, too. I think I saw him in there earlier this week or late last week. So, yeah, it'd be cool to have him on the stream sometime, for sure. Let's see. Okay, Harris, Christmas. Now we're getting into the Christmas traditions. Okay, guys. And I'm sorry, too. I'm like 30 minutes behind in the live chat. I got to catch up. So, Christmas tradition is watch some Home Alone 1 and 2 and Die Hard. Good stuff. Let me keep going. Okay, this is actually a really important question. Sorry, guys. I'm still quite behind, but I do want to address this. Can you talk about, and I actually talked about this in this week's newsletter. This is totally coincidental, but I covered this exact topic this week in the newsletter. So, if you guys want to check it out, if you guys want to read that, you can click the link to go to the newsletter in the description. And on that page that it takes you to, there is, if you scroll down a little bit, it'll take you to a place where you can read all the previous editions of the newsletter. You don't have to sign up or anything. You just click a link. It'll take you to all the old editions. And read the most recent one. And I talk about dividend yield versus yield on cost, because there's a lot of people out there who think yield on cost doesn't matter, but it does. It definitely does matter. Especially if you're a long-term investor, you plan to invest over a long period of time. You want to see how your return is growing over time, because that's what yield on cost measures, right? Like how much income you're generating based on your initial investment against your cost basis. So it is an important thing to know, and you do want to see that number going up over time. But like I said, I cover that more in the newsletter. I hope you guys check that out. Let's see. Sorry guys, I'm really trying to catch up in the live chat here. I'm like 20 minutes behind. I always do this. It's bittersweet. Like it's cool to see these streams getting to the point where it's like you can't keep up with the comments, but at the same time, and I like it where I get so behind in the comments. It's cool because it's just indicative of all you guys just being so engaging, which I love. But I feel bad because I definitely miss a lot of your comments, and I really apologize for that. Let's see. A lot of stock review stuff, guys. I'm sorry, I'm skipping over some of this. Yeah, so the problem I described with discounted cash flow can be solved in two ways. One way is to determine your own growth rate using DCF and to use a margin of safety. Still room for error though. Yeah, I still maintain my position. Discounted cash flow is just one. It's just one tool that you have at your disposal. And never mind. I'm not going to get into it. Kyle, great question. I'll quickly answer this one. What do you think of MPW? Been having my eye on it. Yeah, great. I think MPW is one of the cheapest stocks out there, and just from what I've seen in the financials, it's a really aggressively growing company, so looks good. And I second this, Lucas. Kevin Burgess is the man. He is absolutely the man. But you know what, too? Like, the man is also the man. So, and maybe too, maybe these guys are one and the same. Kevin Burgess and the man. I don't know. But Kevin, thanks for answering that about BDCs. I appreciate you doing that. Some homeless man. Nice. Just hit $300 in annual dividend income. Congratulations, my friend. That's a really cool milestone. Good for you. And that's what happens. That's the good thing about dividend investing. You just stay consistent with it. Like these milestones that you set for yourself, whether it's $300 of annual dividend income, $2,400 of annual dividend income, it's bound to happen. It's like not a matter of if, it's a matter of when. You know. Let's see. Okay, so now I've really caught up. I skipped so many comments in the live chat, guys. I'm so sorry. High tech. So Ryan, did you pull the trigger on Apple stock yet? I did not. We covered that earlier in the stream. That was pretty much like the premise of like what I was talking about earlier. Apple is getting very close to my where I'd like to buy it. And I think if it drops in the mid to low 120s, then I will likely start a position. Let's see. Bestials, this is a good question. So does it make sense to have a business development company in a tax-deferred account rather than a taxable? If you're only looking at it from the perspective of taxes, then yes, it makes sense to have business development companies as well as real estate investment trusts in a tax-deferred account like a Roth IRA over taxable. And that's because the dividends are taxed as ordinary income. So the tax rate's higher. That's why it makes sense. Is this the former tennis player Ryan Williams? I actually used to play tennis back in the day. Yeah, I'm probably not the one you're thinking of though. But if you've heard of me, if the way that you know me is as a tennis player, then I don't even know how that'd be possible. Oh, this is a good question, Hassan. What do you think of VFC as a long-term investor? I'm pretty torn. Like I personally am staying away from the company, but at the same time, I think the brands that they own are pretty timeless. Like Vans, where fashion is mostly cyclical, the companies that VFC owns, like Vans, the North Face, Dickies, those have more or less stood the test of time. Like those are pretty consistently, I don't want to say in style, but for the most part, like those are pretty timeless brands at this point and don't ever go out of trend. Now they do have one. They recently bought Supreme. I don't know how recent, Matt. Maybe in the last few years, couple years. But they bought Supreme, which has its roots in skateboarding, much like Vans. And that is one that I can say is kind of a flash in the pan, or does seem to be a flash in the pan. And I could be wrong. Like I'm not like a hype beast or whatever. But I definitely don't notice people being as excited about Supreme as they were a couple years ago. But otherwise, like I think VFC has some pretty good brands on its roster, but I can't say the financials are my favorite. So I stay away from VFC, even though they are like a dividend king. I think they are maybe 49 years of dividend growth, but it's not for me. Excuse me. No growth, great companies. Okay. Oh, Miguel, that was a great newsletter. Thank you, my friend. I'm glad you read it. I'm glad you liked it. Okay, so Danny, hey Ryan, I love your Google Sheet to track my dividend payouts. I think I just have a problem when I put in ETFs. I can't find what industry and just leaves as basically not applicable or not accessible, whichever. Do you know why? Yeah, so Danny, you might have missed this at the beginning of the stream, but I've been working on version 6.0 of the spreadsheet. In this new version, it will completely fix this issue. Like we will never ever again have issues with sector data loading, which is going to be so nice because you are far from the only one who has been having that problem. In the meantime, Danny, I would just manually input ETF in the sector data for all of your ETFs. And just whenever spreadsheet version 6.0 comes out, which I'm hoping to release sometime in February, just know like these issues will cease to exist, which I'm excited about. Okay. Gosh, sorry guys. I don't know if I told you guys, but I've kind of been sick this week. Really since like Sunday, I've been kind of congested with like a little cold. Nothing too crazy. Obviously, I'm surviving, but yeah. So if you guys hear me sniffling or if I sound weird, that's why. I'm just getting over that. Really on the tail end of it. Okay, last couple of comments because it is about time to wrap it up. So Pizza Pro, hi Ryan. I commented on your last video, the 12-year-old kid, which is extremely impressive, by the way. I do remember this. So he's 12 years old, investing with his dad, and asked about some stocks. So, excuse me, what do you recommend to do when I only have about $400 to invest every year? Man, I would just do what you can. You're 12 years old. I mean, I'll tell you what, like, you have a lot more money to invest than I did when I was 12 years old. And once again, I have to commend you for choosing to put your money into stocks at your age because that is a rarity. And I said this in my comment back to you, but my goodness, you keep that up for the next 10 years, you are going to be thanking yourself big time. You are going to be thanking yourself big time. And you're going to be rolling in those dividends 10 years from now. So, you know, what do I recommend you do? I just recommend you do what you can. And that's all we can do as investors, you know? As you get older and you get a job and you move out on your own, you'll realize that you still have the same problem where you feel like maybe you don't have enough to invest or you don't have as much as you'd like to invest. The good thing is you have a bunch of time on your side. So, you know, don't beat yourself up. Instead, pat yourself on the back that you're choosing to put this $400 towards something positive. I think that's incredible. Let's see. Okay. Jay, Ryan, I still think I think I like Microsoft better than Apple. What do you think? Yeah, I'm so back and forth. Like I really don't man, I don't know. This is such a kind of a cop out answer, but I really don't think you can go wrong either way. Like the strengths for both of the companies, they're good companies for different reasons. Like Microsoft has people say that Microsoft is more diverse in where their revenue's generated and you know they have more enterprise exposure, more business exposure, and they've got the cloud and they've got this, that, and the other, which is very much true. Like Microsoft is a beast. Then again, like I don't want to say in defense of Apple, but talking about Apple, it's like it's hard to compete with Apple's brand, right? Like, I mean, let me give you an example. So I'm on my MacBook Pro. I have my iMac. I'm holding an iPad. My iPhone's right here, okay? And not too far from that is my Apple Pencil. And I don't know, like it's just how do I put that into words? It's just you know, people love their Apple products, and Apple does a really good job of reeling you in. And then once you're in their ecosystem, it's hard to get out. So they're good companies for different reasons, I think. Okay, so guys, I think so. I will answer this because, my friend, I've seen you ask this a couple times in the live chat. Which stock benefit most from the Fed pivot? Dude, I have no idea. I have no idea. Like, I don't even know. I don't know how to answer that. And truthfully, it's something I don't pay attention to. When I'm looking at businesses, I'm trying to as much as possible, not consider like the short-term macro environment, because it's perpetually changing. Like the market's always changing, the economy's changing, what the Federal Reserve is going to do is always changing. And so I just think it's better, and I'm not the only one who's going to say this. Like, I'm far from being the only person who says this, and I definitely didn't come up with this way of thinking. I think Warren and Charlie did. I can thank them for that. But it's much better and much easier, and I also think much more enjoyable to just focus on finding good businesses and not worrying too much about a lot of that macro stuff. It might be good to, in the short term, it might determine like what's going to be at a good valuation, or might help indicate which direction stocks are going to go into. But I don't know which stock is going to benefit most from the Fed pivot. I really don't. So let's see. Jim, have you ever seen The Man and Kevin Burgess together? Food for thought. That's awesome, man. Comment of the day. Okay, so guys, oh, wait, what? See something about Roth IRA here. Let's see. Anyway, I'm pretty much all caught up in the comments. You guys had some good suggestions for pizza there, basically saying just put it in ETFs. And maybe that's what you were asking Pizza a couple minutes ago. Like, what do you recommend do? Yeah, like maybe just go the ETF route, or at least start there. And then, man, you're 12 years old. I still can't believe that. And maybe, and I don't know how long you've been investing. I know you do this with your dad, but maybe from there, if you're feeling froggy, maybe once you have a good position in an ETF or some ETFs like the ones mentioned here in the live chat, maybe then choose a couple individual stocks that you're really interested in, and slowly but surely test the waters with those. Jay's asking about a Roth IRA. What can you elaborate on this question? What do you mean? What do you mean by this? Commented on your votes. What? I'm confused. I apologize. I'm confused. I commented on your votes about Roth IRA. I don't know. Anyway, guys, I think this is a good place to wrap it up. But thank you guys, all 120 of you who are still here in the stream. Thank you guys so much for tuning in tonight. Sorry guys. Which funds ETF should be fine in Roth IRA? Any of them. The thing with the Roth IRA, it's a tax-deferred account. You don't pay taxes when you do withdraw the funds, but there are some stipulations to Roth IRAs. Like, for example, unless there are certain criteria that is met, you can't withdraw from a Roth IRA until you've had the portfolio for at least 5 years or you hit age 59 and a half. So that's one thing to keep in mind. Also, while you're contributing to it, there are maximum contributions you can make. Right now, this year it's 6,000. Next year they're going to bump it up to 6,500. So it's just different. But anyway, like any sort of fund or ETF should be fine in a Roth IRA, because you're not paying taxes on it, and that's the main reason why you'd invest in that. But guys, I'm sorry, goodness gracious, I'm getting out of here, guys, before I fall apart. But once again, thank you guys so much for tuning in. I really appreciate you guys spending this time with me, as always. It was just always a blast doing these live streams. Can you guys hear that frog in my throat? God. But thank you guys so much. I hope you have a fantastic weekend. I hope you have a very Merry Christmas, and I look forward to seeing you guys in the next one. Remember, there's no video this Sunday. The Sunday video is going out tomorrow. If you guys hit up YouTube tomorrow morning, it'll hopefully show up on your browse page, and I hope you watch it. But I hope you guys have a Merry Christmas. I really appreciate all you guys, and I'll see you in the next one.